Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So just in the last couple of months, here in New Zealand, we've had a couple of changes in our ETF options. So if you're not familiar already, an ETF is simply an exchange traded fund. In other words, it's a fund that has a particular investment goal that trades just like a public company that you can buy shares or units in. And it's been a pretty popular way for people all around the world really to go out and easily diversify their investment portfolio and basically get market rates of return. So in New Zealand, we have the New Zealand Top 50 Fund, and I've talked about that several times on the channel before, and that tracks the top 50 companies in New Zealand. But just in the last couple of months, we've had a new fund come out from Smartshares, which is one of the larger ETF providers in the country, and this isn't a Smartshares sponsored video or anything like that, but one of their new sort of lower cost funds was a NZX 50 ETF, and it's caused, I think, a little bit of confusion with Kiwi investors around, you know, what's the difference between this and the New Zealand Top 50. One of my first investments ever was in the New Zealand Top 50 Fund, probably about 3 years ago at this point. I still hold it today. Admittedly, it's a smaller and smaller percentage of my investment portfolio as I add to more sort of individual companies, but I still think ETFs that track the market are a pretty good option for quite a lot of people. So I want to get into some of the details behind this new NZX 50 ETF, and although I can't offer recommendations or anything, even if I did know your personal situation, I want to go through kind of my thoughts and some of the considerations and differences between the two. So I hope you do enjoy. If you do, please hit like and subscribe on the channel. It really helps me out, so I would appreciate that very much. But for now, let's get straight into it. Okay, so firstly, let's talk about the OG ETF, the New Zealand Top 50, ticker symbol FNZ.NZ if you ever want to like Google search this particular, the stock ticker for this particular ETF. And I'll put up some screenshots here from the Smartshares website just so you can see what I'm reading from. But basically what it says is the S&P/NZX 50 Portfolio Index is made up of 50 of the largest financial products listed on the NZX main board. The S&P/NZX 50 Portfolio Index is made up of the same financial products as the S&P/NZX 50 Index, but with a 5% cap on the weight of each product. And that is basically the key difference between this top 50 fund and the new one, is this sort of idea of having a 5% cap. So if we scroll down to basically the top holdings, and you can do this with most ETFs on the Smartshares sort of website, you'll see all of the holdings within that NZ Top 50 portfolio. So if we look through the top holdings, you'll see that a few of them are actually slightly over 5%. You do see that every now and then, but the goal is for this fund to keep things under 5%. And you'll see that the largest companies that make up this sort of index are Fisher & Paykel Healthcare, Spark New Zealand, the A2 Milk Company, Meridian Energy, Ryman Healthcare, Main Freight Limited, Auckland International Airport, Contact Energy, Infratil Limited, and Chorus Limited. So nothing really too unexpected there, other than this cap for this 5% kind of weight within that particular portfolio. The other thing worth noting is that the fund charges a 0.5% fee kind of within that particular fund. So basically what that means is any returns that this particular fund generates, you're going to actually receive about probably 0.5% less than that, because that is the charges that the fund has built in there. So obviously we want those fees to be as low as possible, but that's kind of the current fees for this NZ Top 50 ETF. Now if we go across to the new player on the block, this is ticker symbol NZG.NZ, which is the S&P/NZX 50 ETF. And basically the only difference between this and the New Zealand Top 50 is one, we no longer have that 5% cap. So if a company does genuinely make up more than 5% of the stock market index and of that top 50 index in New Zealand, you will see that represented in the NZG ETF. And the other thing that we have in here is much lower charges, fund charges. So we only have 0.2% versus 0.5% with the New Zealand Top 50 ETF that we looked at earlier. So if we now go through and look at the top holdings in this particular fund, you'll see basically the exact same companies, but you will see them with much different weightings. So if we look at the first two, which are Fisher & Paykel Healthcare and the A2 Milk Company, you'll notice that they make up 17% and 12.7% respectively of this particular ETF, which means we have 30% of the portfolio just made up by those top two investments. So that can flow through to generating very different investment results over a long period of time. But as an ETF investor, you are going to get a much better tracking of the actual NZX 50 index by using something that genuinely reflects the actual weightings of each of these companies within the index. After Fisher & Paykel and the A2 Milk Company, we have Spark, Auckland International Airport, Meridian Energy, Ryman Healthcare, Contact Energy, Main Freight, Infratil, and Chorus. So basically the exact same businesses, but slightly different weightings. So we have roughly sort of 3 to maybe 6% positions from each of those top 10 investments in the FNZ index versus anywhere from 2.7% up to 17% of the ETF made up by those top 10 positions in the new NZG ETF. So what does all this technical jargon actually mean for your results, and what option would I kind of prefer, I guess, is the next logical question. And obviously, please don't take this as financial advice. I'm just a guy on the internet who likes to talk about this stuff. So anyway, I think it's probably a good starting point to just put up kind of the long-term performance of the actual NZX index versus something like the New Zealand Top 50 fund with the 5% cap on each of those particular investments. Now, if we look over a long period of time, let's say the last 5 years or even the last 10 years, what you'll notice is that we actually have some differences in performance between these two. So since we have, that 5% cap built into the New Zealand Top 50 ETF that's been around for several years now, we actually have some variance in performance between that and the actual index. And that's because as companies have grown to more than 5% of the index, and companies like A2 Milk and so on have continued to do really, really well in the actual underlying index, not as much of that upside has been captured in the New Zealand Top 50 fund because of that 5% weighting. And this is really one of the core reasons why Smartshares have come out with this new NZG ETF, is to get a much closer tracking to the index. Now, in terms of the way that I would think about choosing an ETF in each of these particular scenarios, really depends on your investment goals and how you think about investing in ETFs in general. So I'm going to give you my perspective and the way that my thought process kind of works around this. Yours may be slightly different, but this is how I think about it. In my opinion, investing in an ETF is basically an admission that you don't really know what you're doing. And as bad as that might sound, I think ETFs are still a fantastic option, and frankly will probably give you better performance than the average mutual fund or the average hedge fund because they've got so much lower fees. You may be able to do better as an individual investor over a long period of time. That performance is probably going to vary a lot between different individuals, picking different individual companies. But investing in an ETF, a broad market ETF more specifically, so I'm not talking about sector ETFs that might invest in energy or technology or some other ETF which is kind of sector specific. Really talking about a broad market index. It's a way of guaranteeing that you will track the performance of the stock market, and over a long period of time the stock market has performed very, very well. Depending on the country and the period of time that you look at, we're probably looking at anywhere from maybe 6% on the absolute low end to maybe 10 or 11% on the higher end over a very long period of time. And if you compound those numbers out, again, I'll put up some screenshots here of the classic compounding calculator, that works out to have very, very good results. And as long as you can track the market in a relatively low cost way by having these low fees, you're going to do pretty well over a long period of time. That's not to mean they won't go down next week or next month or over the next 5 years even, but over a period of 10 or 20 or 30 years, these investments are likely to do quite well. Essentially what you're doing here is you're making a bet on New Zealand businesses, New Zealand public companies being larger and more profitable in 10 or 20 or 30 years time than they they are today. That's all that an investment in a broad market ETF is. And one of the advantages that you also get is a lot of these companies, particularly in New Zealand, pay a lot of dividend money. So it allows you to receive cash a couple of times a year. You can either live on that if you have a large investment portfolio and that's what you want to do, or if you're like me and you're in sort of growth mode still, you can go ahead and take those dividends and reinvest it in the ETF to purchase more shares and receive more dividends and more dividends and more dividends, to buy more shares and more shares and more shares, and get this kind of snowball compounding effect working really well for you over a long period of time. So for me personally, if I want to invest in an ETF, I'm looking to track the market. And basically, even though something like NZG has 30% of the index made up from those top 2 companies, it does lock in the ability to track the market. So if I was to lean towards one of these 2 options, it would probably be something like NZG. You've got to understand that there are risks to having a concentrated kind of underlying portfolio, but you've also got to remember that the superpower of the ETF investor is they don't care about any of that stuff. They don't care about what's going on with particular individual companies. They don't really care about anything. Frankly, all they should be doing is dollar cost averaging, consistently contributing to this ETF. It means that they don't ever put all their money in at the highest price or put no money in at the lowest price or anything like that. It also doesn't guarantee that they do the opposite. They put in all their money at the low end. But consistently contributing and growing this snowball over a long period of time is gonna, it's gonna work very well for the average person. So those are my thoughts on the new ETF from Smartshares. Fairly straightforward differences. Hopefully that all made sense with the 5% cap versus no cap, and the slightly lower fund charges with the new ETF as well. So like I say, ETFs are making up a smaller and smaller percentage of my personal portfolio, but I know a lot of people have a fair bit of money in ETFs, and they are getting more and more popular over time for pretty good reason. They have solid returns in terms of tracking the market, and they have pretty low fees as well. Which means they'll do far better than the average mutual fund over a long period of time. So those are my thoughts. I do hope you enjoyed the video. If you have any thoughts on these changes as well and some of the things that you're thinking about with your ETF investing, definitely let me know down in the comments below. But that is all from me today, so I hope you did enjoy the video. If you did, please hit like and hit subscribe if you haven't already, and I will see you in the next one. Cheers.